The CRA has introduced some new tax rules that will take effect for the 2023 tax filing year. The most significant changes come in the area of trust reporting. You may be thinking to yourself, I'm not a trustee or a beneficiary of a trust, so I have nothing to worry about. Not so fast. The new rules may put requirements on far more Canadians than most people realize. The impact of non-compliance can be significant fines and penalties, so you want to make sure that you remain on the right side of things with the CRA. In this video, I'm going to walk through what the new trust reporting rules are, specifically focusing on situations that a retiree or a soon-to-be retiree might encounter. I'll explain what your obligations are in these circumstances. I'll talk about some of the exemptions from the new rules. I'll outline the deadlines that you're going to need to be mindful of. We'll talk about potential penalties for non-compliance, and we'll finish with steps that you can take to make sure that you are compliant this upcoming tax season. And if we haven't met yet, my name is Mark Walhout. I run a financial planning and investment advisory business called Walhout Financial, and I created this channel to share ideas and concepts that I'm using to help people with retirement every single day. If you want to get more videos like these, consider subscribing to the channel and hit the bell icon so you're alerted when new videos are posted. So we'll start with looking at what are the new trust reporting rules. The first question you might be asking yourself is, why is the CRA adding new trust reporting requirements? The official stance of the government when they announced these measures initially back in 2018 is that they wanted to help combat, quote, aggressive tax avoidance, tax evasion, money laundering, and other criminal activities. Under the previous trust reporting rules, only trusts that had taxes payable at the end of the calendar year or at the end of the trust year end needed to file an annual trust tax return, also known as a T3. But under the new rules, all affected trusts need to file a T3 return even if they don't have taxes owing. In addition, they must also disclose all beneficiaries, settlers, and protectors of the trust, including their addresses, dates of birth, and their taxpayer identification numbers, such as their social insurance number. Then, if it wasn't already tough enough, in 2022, the CRA announced that the new trust reporting rules would apply not only to formal trusts, also known as express trusts, but they would also apply to bare trusts. Now, bare trusts are not defined in the Income Tax Act, but generally they're known as an arrangement where a trustee is simply holding legal title to a beneficiary's property. The trustee has no powers other than to act at the direction of the beneficiary, and they can't act without the consent of the beneficiary. And this specific distinction opens up a huge can of worms for a lot of people that are part of a bare trust situation, but they may not know about it. Now, I'm going to outline some common retiree scenarios where a trust may be used and subject to new reporting rules, both obvious and not so obvious. So we'll start with the obvious trust scenarios that a retiree, if they're a part of one of these arrangements, they probably know about it, and they might have an easier time identifying that they have obligations under the new rules. First is a scenario where a family sets up a family trust to hold a family cottage. This planning strategy can be used where a family wants to move a cottage into a trust for the benefit of succession planning for the cottage or moving it to the next generation, but still wants to manage and control that asset, provide some measure of creditor protection, and potentially just maintain, again, control over that asset before they pass it down to the next generation. The next trust scenario that's fairly obvious that would have reporting requirements would be what's known as an alter ego trust. And this is also known as like a will substitute. It's a living will for somebody who's over the age of 65. They can put their assets into an alter ego trust and either manage it themselves or have somebody else manage it for them. It can provide privacy in the estate process. It can add efficiency to your estate planning. It could potentially offer creditor protection. But this is a strategy that some retirees or seniors will deploy in order to manage their affairs when they're over 65. The next type of trust that will be fairly obvious is a spousal trust. So it's similar to an alter ego trust, but it's used by a couple over the age of 65 to sort of separate the ownership and management of their assets for their benefit in their lifetime. And when they pass away, it can create some efficiencies for their estate. And then finally, a testamentary trust. So this is a scenario where somebody leaves assets behind when they've passed away in a trust. And if you are a beneficiary of a testamentary trust, you may be aware of this and you're receiving payments from a testamentary trust that was left to you by a loved one. So those are some fairly obvious scenarios. Those are express trusts where a beneficiary, or specifically a trustee in this case, would have knowledge that they have some obligations here if they're aware that there's new trust reporting rules. But now we're going to talk about, to me, what are the riskiest ones for soon-to-be retirees and people that are not aware of these new trust reporting rules, and I really want to make you aware of them today. So some of the less obvious scenarios include, number one, this is a big one, parents who are on the deeds of their kids' houses at 1%. And the reason why a parent might be on the deed of a child's house at 1% is in order to help that child qualify for a mortgage. The lender may have required that they have another party co-sign on that mortgage for them in order that they could be approved for a large mortgage amount that maybe they otherwise wouldn't be able to qualify for. And as part of that process, the lender may require that cosigner be on the deed of the home at 1%. And I believe that this is considered or will be considered in the eyes of the CRA a bare trust, and you will need to report this trust relationship on a T3 tax return for the tax year 2023. And we're going to talk about deadlines in a minute. But we'll refresh again. What is a bare trust? Again, a bare trust is an arrangement where the trustee is simply holding legal title to the beneficiary's property and has no powers without the consent of the beneficiaries. Being on the deed of your child's house at 1%, very much fits this bill. You don't have any powers. You can't do anything with the property without the consent of your child in this case. You're sort of acting at their direction, but you are on legal title. So I believe that this scenario or retirees or soon-to-be retirees who are in this scenario do have trust reporting requirements for the end of the 2023 tax year when it comes to these new trust reporting rules. The next scenario is maybe soon-to-be retirees who were added to the deed of their parents' houses to ease in estate administration. And this is something that I have come across several times. People believe that they can sort of bypass probate by having themselves added to the deeds of their parents' houses. It opens up a whole bunch of financial planning risks. And on top of that, now it adds risk as it relates to these new trust reporting rules. That is considered, in my opinion, a bare trust. And people who are in that scenario will have a requirement, specifically the trustee will have a requirement to file a T3 return for the 2023 tax year. The next scenario, another common one, is in trust accounts. So these arrangements are very common. I think they're less common today, but they were very common over the past 20 years or so, where a parent or a grandparent might set up what's an in-trust account or sort of like a shorthand trust at a bank or with their financial advisor to set aside money for their grandchild in an investment. And in my opinion, this is also going to be considered a trust under the new trust reporting rules and will necessitate a T3 return for the 2023 tax year. So now we'll talk about the types of situations that might be exempt from the new rules. So we've talked about, what are the different types of trusts? What are the new reporting requirements? The scenarios that are clear and maybe not so clear. And you might be now at this point in the video being like, oh my gosh, like how many different scenarios are there out there that might be captured by these new trust reporting rules? So now we'll talk about some of the exemptions. And we'll talk about some of the grace that the CRA is going to be extending to people for these new requirements, because this will impose a lot of new requirements on people that haven't otherwise had them in the past. So we'll talk about some scenarios that are exempt from the new trust rules. So first we'll start with trusts that have been in existence for less than 3 months at the end of the year. So if you created, or if you're a trustee of a trust that was set up in November of 2023, you would not have trust reporting requirements under the new rules unless there was some taxable income or a taxable event that occurred inside of that trust before year end. Next is trusts that hold certain assets, such as cash or securities listed on a designated stock exchange and have a fair market value of less than $50,000. So that might provide some relief to people who otherwise would have trust reporting requirements if it's under $50,000 and holds just certain things like cash and securities. Next is registered plans such as RSPs, RIFs, registered pension plans, registered disability savings plans, RESPs, tax-free savings accounts, and the first home savers account. Those would be exempt from the new reporting rules. Graduated rate estates and qualified disability trusts. And then finally, mutual fund trusts and registered charities. So now we'll talk about the tax deadlines for trust tax returns for the year end 2023. Typically, trusts have a calendar year end, and trust tax returns are due 90 days after the end of the year. That would place the due date for trust tax returns on March 30th, but because of the Easter long weekend, the deadline for filing trust tax returns this year will be April the 2nd, 2024. And the reason that this is of note is that personal income taxes are not due until the end of April. So you have a little bit less time to fill out or complete these trust filing requirements than you do your other tax returns or your personal tax returns. Now, a little bit of relief here, some good news for people that might be impacted by these new trust reporting rules. The CRA released a guidance memo at the beginning of December of 2023 indicating that there will be no penalties for filing a trust return late after the deadline for the 2023 tax year, but only for bare trusts. So those sneaky trusts like that 1% family ownership, or you're on the ownership of your parents' home in trust accounts, there will be grace given. The CRA has indicated that they want to take an education first approach for this first year, but the filing requirement still remains in effect. You still do need to file. They're just not going to hammer people on sort of these edge cases, I think, in the first year, but you still do have a requirement. But if the CRA deems that you should have known, if the trust reporting in your case relates to an express trust, a formal trust, the penalties for not filing here can be very steep. So if you have a tax balance owing, the penalties for non-payment are 5% of the unpaid tax for when the return was required to be filed, plus a 1% monthly penalty on the unpaid tax amount for each month that the T3 is late, up to a maximum of 12 months. And even if you have no balance due, even if you just had to submit a return indicating that you had no tax balance owing, there's a penalty of $25 per day for each day that the return is late, up to $2,500. So as you can see, the penalties can rack up very quickly here, and you want to make sure that you remain sort of on the right side of this with the CRA. So now we'll talk about calls to action to finish the video. If you believe, based on the scenarios that we talked about in this video, and I'm also going to include a number of articles in the description section below that I encourage you to read to just educate yourself. If you believe that you might be in a scenario, or you wonder maybe whether your scenario might catch you in these tax rules, I highly, highly, highly encourage you to reach out to your professional tax accountant or your financial planner as soon as possible. If you do have a reporting requirement, you need to get working on this very quickly, because you need to gather the necessary information from the beneficiaries, the trustees, to make sure that the tax filing is accurate. Recall from earlier in the video that all beneficiaries and trustee identities, their addresses, dates of birth, and their social insurance numbers need to be added onto that tax return. And you need to gather that information and get that to your tax preparer and give them enough time to complete the documents. And then the second call to action here is to make sure that you're mindful of the reporting deadlines. We just spoke about them, but the reporting deadline for trust is typically 90 days following the end of the calendar year. That would land on March 30th, but because of the Easter weekend, the deadline for T3s this year is going to be April the 2nd, 2024. So as more information comes out about the new tax requirements for trusts or the trust reporting rules, I will update you here on this channel. Of course, if you have any questions or comments, please leave them in the comments section. I always do love getting questions. It's a good way to engage and get your questions answered, especially on a topic like this, because I think there is going to be a lot of questions about it. If you like this video, if you watched it all the way to the end, give it a thumbs up and subscribe to the channel so you're alerted when new videos are posted. Thanks for watching this video, and I'll speak with you soon. Take care.